On multifamily deals, as an example, you'll see an acquisition fee, an asset management fee, a management fee, a disposition fees, and you have all these fees. The way we structured it was, so simple, where I have a staff of 9 people right now that, work for me and myself. We don't have fees or ratios. We're all salaried employees who take a salary.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Chris left his cozy top floor corner office in 2022 after 25 years of working in real estate development and construction. He managed over $1 billion in new construction, and he's now grown his note business to over 500 notes. Chris, welcome to the show.
Sam, thanks for having me today. Glad to appreciate being here.
Absolutely, Chris. The pleasure is mine. There are 3 questions I ask every guest who comes on the show in 90 seconds or less. Can you tell me, where did you start, where are you now, and how did you get there?
Yep. So where I started, I've always been in real estate, but the tipping point for me to kind of starting my own path was when my wife and I went to go build our primary residence, because we acted as a contractor. We GC'd that out ourselves, and that gave us a lot of equity to then pull some of that equity out to go start doing some more of our real estate components. So that's kind of how we got started. What was the second part of that?
Where are you now?
Oh, so where are we now? Like you mentioned, last year we launched a Regulation A+ fund to raise $75 million to focus primarily on investing in distressed mortgage notes.
That's fantastic. Okay, so you started, when you did that first GC'd your own home, was that before you launched in your development career, or was that after?
So it was when I was working for a developer. It was right after I started working for a developer. When I worked for a GC, you were working 6 days a week, 60 plus hours. You had no time for managing construction projects, do your own thing. Then when you go to the development side, it's kind of like, the cozy side of things, where all you do is scream at the GC all day long. And my boss at the time, super smart guy, comes to me one day, he goes, "What are you doing for retirement?" And I said, "I got my 401k. And he laughed at me. He goes, "Why don't you own real estate? You've been in it for 15 years at this point in time." And he had 5 or 6 rentals that he had, probably a portfolio at that point in time of like $5 million. And that gave me kind of the start to want to go build my own real estate career.
Got it. And so it sounds like the starting your own real estate career didn't go the traditional route. You've now since launched a Reg A fund. You guys are buying distressed mortgage notes. I mean, was that the next step for you? And how did you get into it, if so?
Yeah, so the next step actually was we were doing some I'll call it the bigger pockets BRRRR strategy. We were buying some properties to renovate, rehab, refinance, and then rent out. And we did 2 properties in the Washington, D.C. area where we're located. And we had 2 little kids at the time. And we were managing all this work. So my wife, after the second one, says, "We're done." It was just too much. And she was right. I mean, it was putting a lot of strain on us. But me being, everyone calls me the squirrel and I can find anything on the internet, I was looking at what else I could invest in. And the challenge that I was finding was, the problem I was trying to solve is, what can I invest in that I don't have to be there within 15 minutes of getting a phone call to put an offer in on something?
Right.
So traditional real estate kind of went out the door. So what I found was mortgage note investing. And when I found it, it actually ticked me off, because I knew of private lending, but I didn't actually know you could buy distressed notes on a secondary market. So when I found out about it, I was actually a little upset, but actually drove me to want to learn more and get involved.
Got it. I love that. It's one of those things, we hear of people, and I hate to say this, but when somebody tells me, okay, I'm a distressed mortgage note investor, I'm a note investor, I think of someone that might, kind of the mom and pop version of note investing. They buy, 5, 6, 7 notes a year, and they hold them and, parcel them out, do whatever they're going to do with those, the various things you can do with notes. You've taken this to a much larger scale. I mean, launching a $75 million Reg A fund is not buying 5 to 7 notes a year. So tell me, I guess when you mapped out your plan for this business, how did you, and doing this at scale takes work, because and correct me if I'm wrong, but I would think you have to have the right industry contacts. You have to have the right people that are selling those distressed notes to you, obviously bidding on probably pools of notes. Tell me just how you kind of wrapped your head around that, educated yourself, and then said, this is how we're going to go big.
Yeah, so very unconventional of how I did this. I started out using my own money, which is conventional, I would say, or recommend, and started buying a few notes. And, that continued to grow. And a few things that I did differently were I'd be in some of these groups or membership classes. And just like any aspect of real estate, 90% of people who are, I'll say sitting at the table with you are window shopping. They're not even going to do it. They're just kind of wanting to see what they could do. So after I started getting, a little, momentum behind me, I was reaching out to those people and say, hey, look, if this isn't something you want to do, come joint venture with me, fund the deal. And, most people would give 50-50 profits. I was giving 60-40. So I was giving a little bit more. So I started to do a lot of those deals, which are one-on-one joint ventures, till I grew to a point where I, wanted to do it within a fund model of a Reg D 506. The first one was B. But when I said unconventional, what was unconventional about it is I knew real estate and I knew a lot of this aspect, and I had some finance background. I actually went back to college, got a master's in finance and real estate, and wrote my thesis in 2020 on how to raise $50 million to do a note fund. And my professors were private equity managers and everybody else who managed billion-dollar funds. So I'm basically paying $3,000 for my, each class was around $3,000. So I paid $30,000+ for my master's, but I was getting the education from people who have far exceeded, anything I probably could get from somebody online. And most people pay that same amount in some of these training courses over a shorter period of time.
And so you had these professors that were in the business, which is rare, I think, in the education sphere, to see these people that are practicing what they're preaching. But these professors that you had were able to look at your plan and say, hey, here's how you can do it better. Were they kind of catalysts that help you refine it? What was that process like?
Yeah, it really helped me refine it in regards to, there's a big difference from, like you said, the mom and pops and buying a few and getting to that scale of where you need to get more of like an institution on two fronts. One is buying the assets, because once you hit, I'd say like a $10 million threshold of capital, that opens up like a completely different realm for you from the type of people who will want to invest with you. You $1 million or $2 million check, but if you only have $1 million, nobody wants to be 50% of your funding partner, a large part. People like to be a small component. But also from a asset acquisition, you see a lot more deals when you're telling people, hey, I want to go buy $2 or $3 million right now, versus somebody who, hey, I want to buy 50,000.
Right. Okay. So you guys said, look, we're going to launch a Reg A fund. Let's get into that. Why Reg A versus Reg D? How did you end up deciding to do this particular model? And what are some of the challenges maybe that you faced along the way?
Yep. So the first challenge with note investing is you are the lender. So you're not taking on any debt. So it's good because your risk profile is very different than, say, a multifamily investor. And a lot of our investors came from investing in multifamily or other self-storage, other types of deals. That challenge is, they can go get, at the time, they're getting 15, 18%, annual IRRs on these other deals, because they're levered. You can leverage it at 3% and 65% leverage to enhance those returns. Note investing, you can't compete with that. If anybody's, saying, I'm going to get you as a note fund 18%, I'd be interested to see the types of assets they're buying, because your risk profile is so high, because the investor money is your leverage. So what the reason, and to answer the question of the Regulation A, is Regulation A does get qualified by the SEC. So it's a much higher cost. I'd say to get qualified is, call it $125,000 compared to a 506C, which can get done for 10, 20 grand. But when you look at your audience, who are you marketing to? When you're doing a 506C and in real estate, you're typically marketing to other real estate investors who are accredited, which is, 1%, 2% of the population, pick a number. Regulation A, you're fishing in the entire ocean because all you have to do is be above 18. Our minimum investment is $2,500. Name a 506C that you can get in the door for $2,500. You can't. So, we wanted to open up that pool significantly to other investors.
Got it. So you said, all right, look, we're going to plop down 125 grand. We're going to launch a Regulation A fund. When you did that, and I know you had some relevant industry experience up to that point in time, joint venturing, buying some notes, maybe buying, I don't know how many at a time, but what did you do to really, I guess, and I'm going to use this to be the wrong term for it, but to maybe this will be the right one, to give your investors confidence, especially your large check investors in a fund like this, that, hey, we can do this at scale and we know what we're doing?
Yep. So prior to launching the Regulation A, I'd actually done 5 other funds.
Okay.
But those funds, the way we did them were, a lot of people just want to go out and say, okay, I want to go raise $20 million and do a fund. I'm an engineer, so, I like to, test and prove different theories and so forth. So we did several different ones and we changed the terms. We had one fund that was like a 50-50 split with no preferred return, no management fee. We did one with a preferred return with a management fee and some split. So we did one 2 years, we did one 3 years. So we did these to gauge, okay, what is the best for both the investor and the sponsor? Because what you don't want to do is go raise $50 million or a large sum of money and have the wrong terms. That can be catastrophic. So we did several different, theories and how we were testing things. And each one of those funds, again, past performance isn't a future indicator of success, but each one, we met or exceeded what we were looking to deliver to our investors. Right.
And that makes a lot of sense. Let's talk about those terms a little bit, because it's something, actually, I was reading a book here recently, and one point that the author made was that as a new fund manager, that a lot of times what he would see is that the sponsors would end up not paying themselves enough. They do see one of two things: either it was incorrectly weighted to the sponsor, and or incorrectly weighted to the investor, to where if you raise a $50 million fund, maybe the sponsor didn't build in enough really fees in there and things to make it worth them staying the course, and or it just was. So tell me how you've kind of thought through that, and what you found were the right terms and the wrong terms along the way. What were some things you did well and some things that maybe you've corrected?
Yeah. So one thing that is we're doing these other funds, there's one offering that we gave too high of a pref and had too low of a management fee. So I essentially was managing this fund for 2.5 years for pretty much nothing till the end. Which, I was still working W-2 at the time, but it was a lesson learned. Did I complain about it? Nope. Did I, change any of the terms? No, it was a lesson learned. So I knew on the next one. On the Regulation A offering, I took what I learned from those other ones, but I also kept things extremely simple. On multifamily deals, as an example, you'll see an acquisition fee, an asset management fee, a management fee, a disposition fees, and you have all these fees. The way we structured it was, so simple, where I have a staff of 9 people right now that, work for me and myself. We don't have fees or ratios. We're all salaried employees who take a salary. So that's an expense that, is up the fund. Everyone fund knows, hey, here's the expense. That way, the people who, work for the company and myself, okay, we have to get paid somehow. Nobody should do anything for free. If they do, you have to be careful, because if things go wrong, they may just want to walk because they're not making any money anyways. Right. For us, we have a preferred return to the investors. And then on the back end, that's where we get, the back end side of things. So that's our incentive to want to do very well on the offering. In the same token, hey, look, we're still getting paid that salary, which again keeps it very simple to make sure, oh, did I underestimate fees? Did I overestimate fees? I don't have to worry about that.
Right. No, that makes a lot of sense. I like that. Yeah. And that's something that we also have been working on here recently. And even deals I'm involved in as a passive investor, it gets really confusing. And I understand this, where it's like, oh, okay, well, we've got a, you know, a 70-30 split, and then up to a 15 IRR. And then beyond that, it goes down to 60-40, and at 18 IRR, it goes to 50-50. And that's if we hit this extra hurdle. And you're like, okay, just tell me when there's an ACH, please, in my account, and I'll just trust you're doing the right thing, because I turned it off.
So that's, you know, that's a great point, because a few things with note investing. One is a lot of people don't understand the process of what you do. So there's that education component. And then when we're raising money, we can't take a multifamily apartment building and say, boom, here it is on marketing brochure, this is what you're investing in. No, we're investing in blind pools, meaning we go raise the money, turn around, and then invest it. So the investors basically really have to know their sponsor and trust us to do the right thing. So if we made it with all these other hurdles and everything, it would, you know, it would be impossible. So we kept it, you know, simple of, hey, monthly distribution, monthly dividend, here it is every month based off of, you know, this annual rate.
Right. That makes a lot of sense. Let's talk a little bit maybe about that. The pool that these pools of notes that you guys are going out and buying. What is what's the temperature of the water? I know it's probably changed in the last 10 years, you know, from one extreme to the other, but like what's that look like right now?
Yeah. Just similar to real estate. You know, I started buying notes in you know, I think end of 2016, I believe. I was lose years. You know, same thing with real estate. If I could have bought a lot more back then, I would have. Sure. You know, based on pricing over the last several years has gone up significantly. Many different factors. One is you know, properties now have a lot more equity in them than they did previously. So that reduces your potential risk, which then of course, you know, impacts returns and valuations. There's been a lot less product. We are at, you know, historic lows for the amount of distressed debt around the country, mainly because of two things. One is the equity, the jobs market, and of course, you know, government intervention, which, you know, besides just having loan programs to help those in need, also during COVID, you know, there was significant, you know, expenditure by the government to, you know, keep people who couldn't work, to keep them employed or keep money flowing to them.
Right. Do you expect that deal flow to increase, decrease? What are you guys gearing up for?
Yeah. So we have seen in quarter4 and quarter4 2022 and quarter1 of 23, we were seeing about, I want to say roughly about $300 million of assets come across our desk each quarter. We've already seen in the first 3 weeks of quarter2 of this year, almost that amount come across our desk.
Wow. And that is strictly distressed debt, or that is a combination of distressed and performing and all the other stuff that goes into that?
It's a combination, but it's been a combination. Okay. What we are absolutely seeing upticks in are the short-term, you know, bridge debt financing that was either fix and flip lenders, DSCR lenders. We're seeing office loans, of course, because those are coming to maturity that, you know, can't get refinanced. Residential. What we're also seeing a lot of, and what's making a comeback, is last several years, there have been no, call it secondary position liens, which are typically lines of credit, because not many people, you know, were getting them or whatnot. What we are seeing is an abundance of recently is people who took money out during 2020 or 2021, took lines of credit out to pay those credit card bills. And now they're back in default on the line of credit because they've racked up that credit card debt again.
Right. Yeah, that's really interesting. And I guess this brings up one more question that we haven't clarified yet. In this fund, what is the type of distressed debt you're buying? Is it commercial? Is it residential? What are you guys focusing on?
Yeah, great question. Primarily, it's residential. We have the ability to do some small commercial, you know, some small multifamily. as well. But we like to balance our portfolio to be about 70% non-performing, 30% performing, to give some cash flow coming in the door on some of those assets. And then the non-performing, of course, also, is our bread and butter. But typically, the loans are single family residential.
Got it. Very, very cool. And I got one last question, and maybe you can and maybe you can't answer this on the air. I don't know. But what's an expected return profile for a fund like this investing in distressed debt? Like what's that look like for the average investor?
Yep. Yeah, we can. So right now, for our investors, our target returns for them are 8 to 11%. For the investor, and that's out. That is to the investor. Now, returns on notes are slightly higher, but when you again have to factor in, your fees and everything that salaries, payroll, all that stuff. That's, and again, it goes back to that comment of no leverage. That's the main driver of that fund. And when people look at, some real estate investors may say, oh my God, that's, I won't get out of bed for 15%. For us, we look back at, you have to always look at, and this is what I always tell people, you have to always look at the risk involved with the return that's being provided. It's not just look at the number for what they say they're going to get. What type of risk are you taking by investing in that deal?
Right. Yeah, absolutely. Absolutely. And I hear a lot of investor sentiment, and for good cause. And it makes me happy because it kind of speaks to my heart, which is, more of the focus on capital preservation, moving into that stuff that continues to produce an income and away from the, I think investors, while we've had a good run and everybody's had a great, and I can't speak for every investor profile type, but certainly seeing that shift more towards, all right, batten down the hatches, let's find stuff that just plods along versus looking for that home run deal. So that's very, very cool. Chris, I've learned a lot from you here today, everything from the challenges and the benefits of raising a Reg A fund, the type of deals you guys are buying, how you guys are keeping deals simple, just kind of what your history was and how you actually got into this space. I think it's absolutely cool. If our listeners want to get in touch with you and learn more about you, what is the best way to do that?
Yeah, so they can go to our website, 7E Investments, which is the number 7, then the letter E, investments.com, or they can email me, chris@7eInvestments.com. You can find me on LinkedIn, Facebook. My last name is, which I'm sure will be in the show notes, is not a very common last name. So you Google me, I'm one of 2 people and that have the same name. I have a cousin in Houston, but he's in a completely different asset class in business. So I'm the only one in real estate.
Fantastic. And for those of you who are just listening, that is 7E, Seveney. So Chris Seveney, that's how you spell his name. And then it is 7E, number 7, the letter E, investments.com. Is that right?
Correct.
Cool. We'll make sure all that is there in the show notes. Chris, thank you again for coming on the show today. I certainly appreciate it.
Yep. Thank you for having me.
Hey, thanks for listening to the How to Scale Commercial Real Estate podcast. If you can do me a favor and subscribe and leave us a review on Apple Podcasts, Spotify, Google Podcasts, whatever platform it is you use to listen. If you can do that for us, that would be a fantastic help to the show. It helps us both attract new listeners as well as rank higher on those directories. So appreciate you listening. Thanks so much and hope to catch you on the next episode.